Sam earns $2,000 this month, but only $1,456 reaches his bank account. Where did the rest go? The missing $544 entered several systems that shape nearly every financial decision Sam makes. $2,000 is Sam's gross pay. The smaller amount after deductions is net pay, meaning the money he actually receives. His employer withholds federal and state income taxes, plus Social Security and Medicare taxes. The exact amounts depend on his circumstances. Social Security is not Sam's private retirement account. Today's payroll taxes largely fund current benefits, while Sam earns credit toward possible future benefits. Withholding is also not necessarily his final income tax bill. Filing later compares what Sam paid with what he actually owed. Now the net pay reaches Sam's bank. His account balance is the bank's promise to return his money when requested. Banks combine deposits with other funding, make loans, buy assets, and manage liquidity. They earn interest and fees while operating under financial rules. The old claim that every American bank must keep 10% is outdated. Federal Reserve requirements have been zero since 2020. Sam's dollars work because people, businesses, courts, and government institutions accept them. Currency has value through usefulness, rules, and shared confidence. Sam spends $1,200 and keeps $256. What that remainder can buy depends on prices, not just its printed number. If a basket costs $100 and broad prices rise 2%, that basket costs about $102 next year. That is inflation, a broad rise in prices that reduces purchasing power. One expensive product alone does not prove economy-wide inflation. Interest is the price of borrowing and the reward for lending. Its direction determines whether it drains Sam's paycheck or grows his savings. Suppose Sam owes $1,000 at 24% APR. In a simplified month, about $20 of interest appears before fees. If he pays $40, only about $20 reduces the original balance, called principal. Then future interest is charged on what remains. His credit score helps lenders estimate repayment risk. Payment history, debts, credit usage, account age, account types, and new applications can matter. A stronger record may help Sam qualify or borrow more cheaply. The score measures information in credit reports, not his worth as a person. When inflation stays too high, the central bank may raise interest rates. Loans become costlier, which can reduce borrowing and spending, but weaker spending can slow businesses and hiring. If economic activity falls broadly and significantly, the economy may enter a recession. A recession is not automatically defined by two negative quarters. Economists also examine employment, income, production, sales, depth, and duration. Sam cannot control that cycle. He can control whether every remaining dollar stays as cash, pays expensive debt, or supports longer-term goals. Cash offers stability and access. Investing accepts uncertainty to pursue growth through assets, such as diversified funds containing stocks or bonds. Investing $150 monthly at an assumed 7% annual return could grow to about $183,000 in 30 years. Sam would contribute $54,000. The rest would be growth, including returns earned on earlier returns. That is compounding. But 7% is an illustration, not a promise. Markets fall, returns vary, fees matter, and diversification reduces risk without removing it. Time makes the difference because growth gets repeated. Waiting 10 years leaves fewer rounds of compounding, even if Sam later contributes more.